Another portfolio review and another worrying portfolio, I'm afraid. Let's have a dive into it. So I got this through. Remember, if you want a portfolio review, have a look at alpeshpatel.com/links. Now, this individual, his major investment problem is a lack of growth. I get so many people saying this with their pensions. And they've got about 200,000 in and they have got no growth, and they're with St. James's Place in this case, which is often the case as well. I'm afraid it seems to be low growth goes hand in hand. And St. James's Place have decided to spray and pray and shove them in a ton of funds. Okay. Now, there's several problems with this. First of all, the low performance is one thing. The client is clearly unhappy, and I suspect when they say lack of growth, what they mean is they could have done better in a bank account. Secondly, with these funds, the fund managers will probably have 50 to 100 stocks in each of these. In the case of global equity, it's probably 1,000 stocks, and they've sprayed and prayed amongst those. So there'll be individual equity holdings which are like 0.1% of his portfolio. It's like he's got £20 in a Microsoft stock, because that's how the spraying and praying bit works, which makes it just a waste, a drag on performance, a waste on fees. In actual fact, if he really wanted to, and I suspect he doesn't just want funds, which tend to be a basket of stocks because of lower volatility, and you want lower volatility because you're closer to retirement, I suspect 3 exchange-traded funds would have done. Okay, and exchange-traded funds, not these actively managed, very expensive fund manager-run funds. So that's the first thing. And the second thing is individual equities, maybe 15 to 20, 20 to 40 equities, picked based on ticking the value, growth, income, cash flow, Sortino, Alpha boxes, and then hold for 12 months, reevaluate. And if anything drops over 25% from the highest it's been since you bought it, you would have exited, and you monitor it for 5 minutes every 2 weeks. That as a formula would have worked more suitably, I suspect, for this client, given what they want. And this is the problem. Very often, the IFAs, the wealth managers, they will say, well, I know you want some equities and I know you want this, but actually what I want is to make sure you don't complain too much. You hold on for 5 years and you turn around and then you say, well, we didn't make anything, but at least we didn't lose anything. And you keep getting the fees as the IFA. And the IFA's hands are tied by whatever they're getting kickbacks from. So they're only going to suggest funds where they're getting kickbacks, and the various funds come along to them and say, hey, listen, you haven't given my international equity fund a push recently. Can you do that? So you go, yeah, I'll shove it to a few clients, keep everybody happy, keep the kickbacks coming in. And all in all, the client gets screwed with low growth, and sooner or later the clients realize. And I'm afraid that is the sad situation we're often in. And that's partly because the clients themselves don't know, and it's not their fault. They don't know how to select an exchange traded fund. Very simple. I want performance to be up over 1, 3 and 6 months, and I want a high Sortino and high Alpha. You can look those things up elsewhere. Separately, and I only probably want 3 exchange traded funds. Separately, in terms of cash or fixed income, I can find good high rates for those. I can probably get about 4 or 5% on that alone. And then with individual equities, I want to tick value, growth, income, cash return on capital invested box, Sortino Alpha again, and low volatility under 20%. And that will give me, well, when the market has a tailwind like last year with the NASDAQ up 55%, that'll give me a 50% rise in my bloody pension. It's as simple as that. And then 12-month review, monitor for 5 minutes every 2 weeks in case anything's dropped from the highest it's been since you bought it, and then do the process again for the next 12 months, because you don't buy and hold forever, because the world moves too quickly to be able to do that. And you do need to monitor every fortnight for 5 minutes, simply because you want to hold on to any gains you've made. If you're in massive outsized gains, as we did last year, we don't just leave it for another 10 years in the hope that they'll stay. No, they might get whittled away. And that's why now I've given a very quick summary on all of that. But have a look at my various channels, or have a look at alpeshpatel.com/links if you'd like to know more. And hopefully this has been very helpful to you. Thank you very much.